Stock market investing is often portrayed as a straightforward path to wealth. Anyone can get rich with the right stock picks or by following a simple buy and hold strategy. At least that's what some people think. While there are definitely endless opportunities to become extremely wealthy through the stock market, the reality of investing is far more complex and less glamorous than it is often made out to be. Behind the promise of high returns lie uncomfortable truths that every investor should confront. Understanding these truths is critical for long-term success in the market, even if they're difficult to consume. My name is Chris, and I help teach people about money, personal finance, and investing. If you're interested in improving your financial future, make sure to subscribe to the channel and hit the like button if this video is helpful. The S&P 500 is viewed as a well-diversified index because it includes about 500 large companies, but it's not as spread out as it seems at first glance. Since the index only covers large-cap companies, investors actually miss out on valuable exposure to medium and small businesses that can offer growth potential and different risk profiles. Adding to the concentration, around a third of the index is made up of tech companies. Heavyweights like Apple, Microsoft, and Amazon dominate long-term returns. Tech giants like Amazon and Google, for example, don't pay dividends, but have delivered massive stock price appreciation over the years. Rather than handing out leftover profits to shareholders, these non-dividend paying companies reinvest the earnings into strategic growth opportunities, potentially using the capital more effectively than individual investors might on their own. Dividends can also create tax implications, meaning some investors prefer to avoid them in taxable accounts. In many cases, the potential for capital growth can outweigh the importance of dividend payments, making them less of a priority depending on the individual's investment plan. A stock market crash generally occurs when the market experiences a drop of 20% or more, and since 1950, the S&P 500 has gone through this unsettling event 13 times. On average, these crashes result in a significant decline of around 33% and typically last about 338 days. For many investors, watching their portfolio shrink during these turbulent times can feel like an eternity, leading to considerable anxiety and stress. Even worse, when the market plunges due to economic turmoil, investors are left concerned, wondering if the market will ever recover at all. Each stock market crash brings fresh uncertainty, new challenges, and the possibility of events that may prevent the market from ever fully recovering. This worry often pushes them to make hasty decisions, such as pulling the money out of the market at a loss. Not only does this cause them to lock in those losses, they probably won't consider getting back into the market until things are nearing all-time highs again, both of which can be a major setback for their long-term goals. It's worth noting that since 1980, the market has experienced and have a long-term plan to ride out the market's ups and downs. The rapid fluctuations of the stock market can easily make you fall into shiny object syndrome, where you get sidetracked by the latest trends, popular sectors, hot stocks, or flashy investment strategies. With social media and financial news always buzzing about the next big thing, it's tempting to jump on every trend, hoping for quick profits. But most people are too slow to actually benefit from this kind of approach, and in reality it brings more reliable growth over time. Investing in the stock market isn't as straightforward or glamorous as many people think. Sure, there are chances to build wealth, but there are some uncomfortable truths that everyone needs to face. From the limited diversity of the S&P 500 to the slow growth that can frustrate new investors, it's clear that making it in the stock market takes patience and a solid game plan.